name is Brody, and I'm here with my flight crew, Nick, Drew, Sam, and Garrett. And looking ahead, we see clear skies for Sun Country as the stock is ready to take off. We are issuing a buy recommendation with a 12-month price target of $22, representing an upside of 33% as of yesterday's closing price. This is based off of 3 catalysts: a positive travel environment, an agile peak demand strategy, and an extensive expansion of the cargo segment. And now I'll hand it over to Sam to give you a little overview.
Thanks, Brody. Consumer airlines are categorized into 3 main categories: ultra low-cost carriers, low-cost carriers, and network legacy carriers. ULCCs such as Sun Country provide low-priced, unbundled fares. LCCs operate similarly but offer higher base fares, often including additional amenities, whereas NLCs provide a higher-cost, full-service experience. Founded in 1982 and IPO'd in 2021, Sun Country began as a charter carrier, eventually expanding to cargo and passenger services. Passenger accounts for 85% of revenue, which includes scheduled service, charter, and ancillary services. 10% comes from cargo, and 5% comes from other, which includes Sun Country vacations, aircraft leasings, and credit cards. Next, Drew will go over our first catalyst.
Thanks, Sam. We surveyed over 300 Midwest consumers when covering key insights. First, travel demand remains stable, with over 50% of respondents expecting to travel as usual, and over 30% expecting to travel even more. Overall, the outlook is positive, with only a small portion expecting to travel less. Second, our findings reveal consumer preferences aligning with Sun Country's business model, with over 70% prioritizing price, 10% valuing convenience, and only 8% focusing on brand loyalty. Next, we'll take a look at some recent travel data that supports our consumer survey findings. TSA throughput has surpassed pre-pandemic levels, with U.S. airports seeing a 5.2% increase in travelers from 2023 to 2024, reaching all-time highs. This signals strong market growth for Sun Country. In addition, new GDP data shows a rise in hotel bookings driven by increased consumer spending, signaling a boost in both leisure and regional travel, which we believe will continue to benefit Sun Country into the future. Next, Brody will show us how Sun Country's agile peak demand strategy allows them to capitalize on these consumer trends.
Thanks, Drew. Sun Country employs an agile peak demand strategy that is built off of a unique route planning system to optimize schedules and maximize total revenue per average seat mile. The company states that during off-peak demand, aircraft are parked as nonstop flights are not essential to its performance, helping lowering operating costs and improve efficiency. Additionally, this strategy not only enables Sun Country to spread employees across all business segments, but to also train, insure, and move pilots and flight crews across the entire business as they receive the same training initiatives. Unlike airlines with multiple aircraft models, Sun Country operates a single fleet of mid-life Boeing 737 next generation aircraft. This strategy helps mitigate high capital expenditures, including maintenance and purchasing costs. By utilizing a streamlined fleet, Sun Country mitigates unanticipated operating costs that can adversely impact revenue, profitability, and margins. This strategy positions Sun Country as an industry leader in profitability. Now let's hear from Nick on how Sun Country is growing the cargo segment.
Thanks, Brody. Sun Country is set to receive 8 additional aircraft to operate for Amazon Air, expanding its cargo fleet to 20 aircraft. Cargo operations further differentiate Sun Country by giving the company a diversified revenue stream through a segment with less seasonality throughout the calendar year and little reliance on the factors that impact leisure travel demand. We expect cargo revenue to grow by 70% year over year and to make up 16% of total revenue by the end of 2025. Due to these factors, Sun Country will be able to grow revenue and decrease seasonality within their business. The company won't have a need to acquire any new aircraft until 2027 or 2028 due to the expansion of cargo and pulling off the leased aircraft throughout 2025 and 2026, allowing for continued revenue growth without new acquisition of aircraft. Sun Country can still grow with minimal capital expenditures. With a significant decrease in capital expenditure, Sun Country will be able to generate the highest levels of free cash flow since the company's IPO. Given this, Sun Country can continue to optimize its balance sheet through debt repayment and share repurchases. Next, I'll hand it off to Garrett to go through our financial analysis.
Thank you, Nick. Revenue grew at a CAGR of 19% from 2021 to 2024, driven by the post-COVID boom, expansion of the number of aircraft flying the passenger segment, as well as new markets that the company services. Going forward, we have a revenue growth CAGR of 8%, driven by cargo expansion.
The additional 8 more aircraft flying under the ATSA agreement with Amazon this year will provide an uplift in revenue. The company will pull aircraft off leases by 2027, indicating that management has an expectation of a very strong future. Historically, operating expenses have been around 90% of total revenue. The two main components are jet fuel and wages and salaries. We view that jet fuel prices will come down in the next 12 months, and the management team has no formal hedging policy right now, so they will realize the full benefit of these lower prices. Wages and salaries are expected to increase at a faster rate than before, but we view this as positive as it means that the company's hard engine and also carrying out the future engine and also carrying out the future realm. EBITDA and net income are going to grow at a faster clip in prior years as a result of OPEX growth growing slower than revenue and the agile peak demand strategy. Some countries have generated 3.7% economic value over the past 3 years. ROA is set to grow 16% by 2026 due to efficient asset use. Share purchases totaling $118 million since 2022 should drive ROE to 20%. By 2026, ROIC is projected to rise to 17% in 2026, supported by strategic aircraft purchases and disciplined capital management. Some countries' 2024 capital allocation strategy will add value creation through debt repayment, payment of leases, capital expenditures, and share purchases. Now, we will talk about commerce.
Thanks, Jared. As we can see in some countries' EBITDA margin, the company leads the industry in profitability with unmatched margins, surpassing both Allegiant and Southwest while performing in line with Frontier. With an efficient business model focused on cost discipline and revenue diversification, some countries drive superior profitability on the bottom line with that margin. Lastly, their focus on operational efficiency within both their leisure and charter segments supports their industry-leading load factor. Next, Nick will build on some countries' valuation.
Thanks, Drew. For our main valuation methodology, we use the 10-year sum of the parts discounted cash flow valuation methodology, given the diverse segments that Sun Country operates. Using this valuation methodology, we came up with a price target of $22. Revenue growth was a key input for each of the segments. The short-term growth rates came from our 3-year model forecast and an aggregate average 8%. And for the short-term growth rates, we use an average of 4%. Due to the inherent sensitivity of our DCF valuation, we conducted 2 separate Monte Carlo simulations with what we believe to be 2 of the most important variables, long-term revenue growth and WACC. The green portion represents a price target with at least 12% upside, and red represents a price target with at least 12% downside. For the long-term growth rate scenario, 64% of iterations resulted in a buy rate, and the WACC scenario, 82% of iterations resulted in a buy rate. To support our DCF valuation, we use an EV to EBITDA relative valuation methodology, given the large peer group and capital-intensive nature of the airline industry. We have given Sun Country a multiple of 6.5 times, aligning with the industry's median and representing an upside of 33%. For 2025, we are forecasting EBITDA of $263 million, implying growth of 32% year over year and a margin of 23%. Next, I'll pass it over to Sam to go over our Sun Country's ESG initiative.
Thanks, Nick. We assigned Sun Country an ESG score of 8 out of 10, which is leading its closest competitors. The company is significantly more environmentally friendly than its peers, as it flies fewer total miles and incorporates the use of SAF. The company participates in impactful social initiatives, such as its partnership with Make-A-Wish, ensuring Wish kids can safely travel across its network. Stewarded by a seasoned management team, the company is well positioned for long-term success. Sun Country's leadership is spearheaded by CEO Jim Bricker and CFO Dave Davis, both of whom bring extensive experience in the airline and finance industries. With a significant portion of their compensation tied to performance, we believe they are strongly incentivized to act in the best interests of shareholders. Next, Garrett will go over our investment risks.
Thanks, Sam. The 4 main risks that Sun Country faces is the ATSA agreement termination, unfavorable union decision, airline industry decarbonization, and a weak consumer. Although these risks do have an impact on the business, we believe the likelihood of them materializing is low. Now, on to Brody for our conclusion.
Thank you, Garrett. To reiterate, we are issuing a buy recommendation with a 12-month price target of $22, representing an upside of 33% based on pre-catalyst, a positive travel environment, an agile peak demand strategy, and the expansion of the cargo segment. Thank you, and we'd love to open it up for questions.
Should I go that? Okay, so I'm calling in, and you're on the south side, right? And you'll know my name, and you'll know that I work for a hedge fund, but you don't know if I want to be short or long, or if I've already got my position on. What are the short sellers saying, the bears?
Yeah, so a big part of the short thesis here is that we consumer because of how much the passenger segment does make up for the company, as well as if Amazon has less orders coming through, there's going to be less cargo flights going on, so then that would be the short case. But as our channel checks indicated, that the consumer is stronger than what has been said, what's been seen, so we don't see that being a huge risk to us.
And then you mentioned I'm thinking about capital allocation, you mentioned you're not going to have to buy planes for quite a while, but what other costs are going to go up as a compensating factor because the planes are getting older?
Absolutely. So it is a stated fact that due to the older aircraft that some country operates, maintenance and overall just life of the aircraft is going to go up. However, we don't view this as a negative impact to the company. As stated in their 10K, they have not scrapped a vehicle before, and they don't plan to scrap any vehicles going into the future, or aircraft, my apologies. And they view this as a tailwind, given that they operate on a mid-life aircraft, and they also have aircraft coming in from the cargo segment. So they don't view this as something that's going to affect them going into as far as 2027, when they say is the year that they plan to potentially acquire more aircraft.
So you have that in your estimates of expenses, though?
We do.
That's a good question. Have you done analysis on the ownership, given that this is a private equity owned company? I mean, public, right? But do you know the ownership of Apollo so far and what they intend to do? Typically, private equity companies don't hold stocks forever.
So yeah, actually recently Apollo ended up selling their whole stake out of the company. They previously held around 20% of the company, and within the last couple of weeks, they did a secondary offering to get those shares back into other shareholders. And with that too, Sun Country also repurchased $10 million worth of shares during that offering.
Add on that question, if Apollo is selling it, why should I buy it?
Yeah, so, thank you. So as we can see with our first two catalysts, our biggest catalyst is going to be that strengthening of consumer, which we don't believe has fully been realized by the street. As our proprietary research shows, about 80% of consumers are expecting either same and or more travel in the next 12 months, which is going to fuel their biggest revenue segment, that passenger segment, which comprises of 80% of their revenue. So, fueled by our first three catalysts, our underlying thesis are why we think you should buy this stock.
Maybe just one other one, while you're on this slide. What did you think after you did this survey and you saw that the majority of people that are customers, the thing they care about most is price? Wanting to be in a business where all the customers care first about price. The second question on your other slide, you said that you thought that there was growth, but it looks like your two graphs are sort of flattening out.
Yep, so thank you. So we actually, for our survey, targeted Sun Country's home base being MSP, being that most of the revenue is gathered from MSP itself. So although this is our overall thesis for the consumer, whereas our next slide, the more macro data, TSA throughput and the increase in GDP, hotel bookings is more of a support to that, because that, again, is nationwide, whereas our initial survey signifies consumer consensus in Sun Country's home base.
Thank you, guys. Just wanted to ask a question on the SOTP DCF. So I like the approach. I think it's thoughtful and unique.
I'm a little curious how you guys thought about allocating the CapEx across the different segments, just given the shared fixed costs between the businesses.
So here is how we attributed it. With CapEx, it is heavily weighted towards the passenger segment with scheduled service and charter, as those two segments make up the highest amount of equipment purchases like aircraft, engines, etc. So those two are split evenly given the portion between scheduled service and charter, and then minimally towards ancillary and cargo, just because they're with ancillary, we wanted to attribute some to just equipment, some of the minor equipment that goes into those products and services, as well as cargo for minimal maintenance that Sun Country is on the hook for with their agreement with Amazon.
So we've all seen the news recently of some of the consolidation, whether successful or not in the industry. Do you see Sun Country as a buyer, a target? And if so, how does that kind of alter your recommendation?
Yeah, so if you're referencing Spirit Airlines going bankrupt, we see that as more of a moot point going forward for the year. It might have more impacts later on, but with all the antitrust regulation from the government, M&A in the ultra low cost carrier space is very hard to pass through. So we don't see Sun Country as a target and acquirer. We see them focusing on their business and building it organically. Yeah, so last week at the Barclays conference, managers stated they don't see themselves as a target because of their three unique business segments. It would be hard for an acquirer to realize synergies through acquiring Sun Country.
I know you've got a balance sheet in there, but I didn't see mention of capitalization, debt to EBITDA, how levered this company is.
So total debt to assets is around 1.1 times.
What view of debt to EBITDA? Or adjusted debt to EBITDA?
It's going to be right around that 1.1, like 1.15, that range for debt to EBITDA.
You guys snuck in a little comment that you think jet fuel will be going down over time. Maybe elaborate a little bit on why you think that's the case, and then the broader, last time on that, the broader question is, for a ULCC in a very competitive industry, do you want lower jet fuel or higher jet fuel?
Yes, so thank you. So currently crude oil is in a backwardation looking at the futures montage. So crude oil is expected to be lower over the next 12 months, and since jet fuel is derived from crude oil, we expect it to be lower, in addition to management's commentary about jet fuel prices coming down. And for your question about in the airline, in the ULCC space, would we prefer lower, higher jet fuel prices? We would prefer lower prices. That way they'd be able to realize more profit as, for example, Sun Country does not hedge the price of fuel.
So historically, the airline industry is one that you could say has an above average failure rate. How did you think about investing in an airline in an industry that has an abnormally high failure rate?
Absolutely. So the first thing we wanted to assess was what Sun Country was doing that was different than competitors, and that is their diversification. Sun Country has three unique business segments that historically show diversification and them being flexible within their business. And looking into that, we saw that as a huge advantage against other airlines, and it stood out from competitors. And looking into that deeper, we feel confident that this strategy is something that they can use during off-peak demand or economic downturns as something to keep them ahead of competitors.
Thank you.